So obviously we're talking about June 2020 and obviously unusual times as we come out of COVID still. But in summary, the market is carrying on. It's as if COVID never happened, and yeah, it's just like a cloud passed over, and the real estate market is just carrying on back to normal, albeit unusual normal, in that it's, you know, we've been 5 years in a booming market, and the market just carries on and is defying any COVID pessimism. And there has been lots, as you know, there's a lot of people talking about the market will collapse. A lot of people will bring their properties on the market because of financial pressure, and the demand will collapse. And as a result, there'll be, considerable price falls. And I'm not suggesting that's not possible, but certainly there is absolutely no sign of it yet. And so what we have here is the number of new listings. So the blue chart shows the monthly results, and remember, this is the Wellington region, so we're seeing highs here of sort of 1100 odd, and lows in here at sort of 500 odd. And as you can see, we've had now I just need to, sorry, I'm just going to get rid of these little videos in my corner because I can't see the graph. There we go. When we had COVID and the lockdown happened, this we saw this happening, far fewer listings coming to the market. Not surprising, no one could show property, no one could view property, so therefore no one wanted to list property. As soon as we got back and we were open for business again, so this one here is June and this one is May, and of course April was when we were in lockdown. So as soon as the lockdown opened, properties started coming back to the market, but they were not coming back to the market in enormous numbers. And so you can see from the red line, which shows the 6-month moving average, the general trend has been gradually over time, the number of new listings coming to the market has slowly reduced, slowly. And that is consistent with what we're seeing now. So there have been, if we look at the June 2020, 536 listings compared to June 2019, 530 listings. So that is the same as last year for the same month, as if COVID was never happening. And now that is a low number of listings, but you can't say that's because of COVID. There's sufficient confidence in the market for the vendors to put their properties on the market. And indeed, we've seen a couple of months worth of good solid results, giving vendors who do want to sell the confidence that properties are selling well and for good prices still. So same sort of volumes as of 12 months ago, but still the general trend is continuing, and that is for low listings and slowly getting even lower. In terms of price, median sales price, and of course, this is median sales price. I do recommend, if you really want to know what's happening to sale prices or to values of, underlying values of properties, that you should look at the RENZ house price index, because that takes into consideration the value of the properties that are selling. If you get 1 month where we got a lot of very, very valuable properties being sold, then that might skew the median price up. But over time, it still tells a story. And the story so far is just a continuation of the same trend. So again, the blue lines show monthly median sales prices, and the red line shows the 6-month moving average. So up 10% on June 2019, and that's not too different. I mean, you can see here that the results for the last couple of months are lower than the 3 months preceding it. But the trend is still evident there. We'll see. I mean, perhaps if you get another 3rd or 4th month where you have sales values, median sale prices rather, at the same level, then that would start to indicate a trend. But certainly from what we can see on the front line, selling houses over the last couple of months, our view is that prices that are being achieved are still very strong in terms of the stock that we're selling at Low & Co anyway. excuse me. So how long has it taken to sell? So there you have it again, June 2020, 34 days to sell a property, and June 2019, 35 days. So this is not indicative of a market slowing down. This is about the same amount of time as a year ago, in fact, 1 day less. And again, you can see there that this result here, hopefully you can see that on your screen, that was May 2020. Things in that month, on average, properties had taken considerably longer to sell, like 54 or 55 days, I think it was. But that's not because there was no demand. It was because for a month, or indeed 5 weeks, we couldn't show properties at all. And then for another 2 weeks after that, we were really, really limited as to how many people we could show through a property. No open homes, and only 2 groups through a property at a time. So it's only natural that properties took a lot longer in that environment. So as soon as we were back to normal, or sort of quasi-normal environment, the duration to sell has come straight back down to what it was 12 months ago. So again, no real change there. It's as if COVID never happened. Number of sales, and again, this is just a very consistent story, similar with the theme we've seen so far. June 2020, 700 sales in Wellington Region versus 689 in June 2019, so marginally up by 2%. And again, you can see here, this was the month here of April. Naturally, very few properties sold in April because we couldn't show properties. As soon as the market was back open again, the number of sales returned. Now, in May, it was somewhat subdued, down on 12 months prior, but in June, it was basically back to pre-COVID levels as of 12 months ago. Now, again, you're seeing here a gradual eroding of the number of sales taking place each month over the last 5 years or so. Does that suggest that demand for property has decreased? I don't think so, because if that was the case, we would see prices stagnating or possibly falling, or at least price growth seriously slowing down. The reason I'm suggesting that fewer properties have been being sold is that fewer properties have been coming to the market. So it's not a subdued demand, it's more of a constrained supply. Now, this is one bit of data which puzzles me. Can't understand why this is showing up, but nonetheless it is. And so this is the data which I have received, and so this is what I'll feed back to you, and that is that the inventory of properties on the market in June 2020 was 11 weeks worth of supply versus 8 weeks in June 2019. Now that would indicate a softening of the market, a general increasing in the balance between supply and demand, because what this is saying is if properties continue to sell at the same rate for 11 weeks, if properties continue to sell the same rate and no more properties came to the market and every property sold in the same number per week, it would take 11 weeks to clear the entire inventory of stock on the market versus 8 weeks in June a year ago. But given we've seen the same number of properties selling 12 months ago, given we've seen broadly the same number of new listings come to the market, and indeed I'll show you soon, we've got a decrease in the overall number of properties available for sale on Trade Me. I can't understand how that translates into a larger number of weeks worth of inventory on the market. But nonetheless, that's what's come out. So you know, that's what I'll report. But as I say, I don't understand that. It seems to be an anomaly, so it'll be interesting to see what they report next month. And as I said, the next one is number of Trade Me listings. And this is a theme, as you can see from the data again, the red line showing the 6-month moving average. And you can see that from, 6 years ago, 7 years ago, we were coming off much higher numbers. So up to 4,000 when I started measuring this, just over 5 years ago, 5.5 years ago. And as of today, or in July, we're talking 1,366, and I think that was the number as of about a week ago when I put these numbers together. So that is, what's that? It's about 35% of the gross numbers of properties on Trade Me that we saw 5.5 years ago when I started recording these numbers. So certainly very low on the supply. And since we had the boom started in 2016, which is here, the boom happened, the demand increased dramatically, and it soaked up all this extra supply. And so, and since then, we've been running at really quite low supply volumes. But in the last 12 months or 8 months, we've come down below a moving average of about 1,500, you know, for the first time that we've ever seen it. And so at the moment, indeed, we've got lower stock volumes in Wellington, and it's no different in the city than the rest of the region. The trend is the same, lower stock volumes than we've ever seen. So partly that is winter, but it's also, as you can see here, you know, the dip in the 6-month moving average never has before gotten below 1,500, and we are now hovering at or just below or just above 1,500. So it's the lowest stock volumes I've ever seen. So although it's winter, and although we've just had COVID, and although we're in a recession, if you are thinking that is this a bad time to sell, the answer is unquestionably no, because there is very little to compete with at the moment. If you're up here and you've got 4,000 properties on the market, that is a tough environment to sell in. This is not a tough environment to sell in. So very low on the supply side of things. And as you can see here, down 18% compared to 12 months ago. A couple of other interesting charts that are just sort of one-offs, not my regular monthly charts. This here is some numbers I've pulled together on number of inspections, number of listings, and the amount of buyer activity per listing. Obviously, this is just at our company at Low & Co. And so this is the last graph on the bottom here, the one you can see with my arrow pointing across it. That one is the one that's particularly interesting, I think. And what this is showing is that at the start of this year, as we opened up in the market, you see this boom in the amount of activity that every listing is seeing on average. This is number of inspections or number of open home attendances. And then as the supply comes on thicker and faster as we get into February and March, as more people bring their properties to the market, more competition, this is showing less buyer activity because the number of listings increases and the number of buyers in the market doesn't necessarily increase to the same degree. And then we had COVID. And so the amount of activity per listing in here during lockdown and just after it was very suppressed. And as confidence has returned after we've opened the markets back up again, as we're able to conduct business and transact as normal, it comes back to these are sort of normal levels, and this is the same sort of level as we see as the market opens in the new year, which is kind of the busiest time of the market before all the listings have come on to soak up all the activity. And so what this is showing us is that buyer activity you know, in the last month or so has been as strong as it was, or almost as strong as it is in the first few weeks of opening the market in the new year, which is the strongest you ever see. So very, very good, strong buyer activity now that we're sort of clear of lockdown and so on. So again, an indication that it's a strong market. There's good, strong demand out there, and for sellers, there's not too much competition to compete with. So a very good market for sellers, indeed a seller's market. And this is another one courtesy of Tony Alexander, which I saw in his latest weekly report, potentially explaining why the market is defying everyone's pessimistic predictions, or one of the reasons why at least, and that is immigration. I remember as we were in lockdown, everyone was predicting that New Zealand's immigration was going to collapse to pretty much zero. And this has absolutely not happened. So you can see here that we are now at immigration numbers that are not quite at the absolute peak that we've ever seen, but close to it. And is this because we have a whole lot of people coming in from Europe, from the Americas, from Asia to live in New Zealand? Obviously not, because our borders are shut. what it is it has to be a combination of Kiwis just coming home because they're returning back to safety, and no Kiwis going overseas. Obviously, these people have to live somewhere, whether that be rent somewhere or buy somewhere. I have to presume that at the moment there's a lot of these people who are bunking in Auntie Agnes's spare rooms, and of course a lot of them are staying at the government quarantine facilities, but they're only there for 2 weeks, and after that they have to go somewhere. There are a number of temporary working visa holders that of course have been returning home too. They don't qualify, I guess, for the same welfare treatment and so on. So when they lose their jobs, they go home, but not nearly to the same degree that we have seen Kiwis coming back. So I think it was about 80,000 net for the last 12 months, and coming into the country. And you can see that as of a year or two ago, we were down at more like the 50,000. So immigration still extremely strong on a net basis. Will that continue? My personal view is, yeah, it will, because Kiwis are not in a hurry to disappear over to America, to the US, to Europe at the moment with what's going on. Well, New Zealand is a great place to be, and there would have to be a bunch of Kiwis. I believe there's still about 1 million Kiwis overseas at the moment, and so surely a chunk of those are going to be wanting to come back home until all this settles down, at least for the next 6 to 12 months. That's got to have a positive sustaining force on keeping immigration high, which will of course continue upwards pressure on the property market. Now obviously there will be some downwards pressures too as a result of the recession which we're in. Some people will be earning less money, some people will have less affordability, and so on. So which force is going to win in the end, who knows? But certainly so far we have seen no softness in the market in Wellington.
Adam, this is Arthur.
Someone's got a question there.
Yep, Arthur here. They're under 12. Was it week 12 or month 12? We're getting quite a large negative.
That's 2012, Arthur.
Oh, 2012.
Yeah.
Okay.
So here is 2020. This is 2012. So that's 4 years into the GFC.
Right. Okay. Yep.
And so I remember at that point there, we're seeing huge numbers of people disappearing over the ditch to Australia.
Right. Okay. Thanks.
Yep. That's very good. Thanks, Arthur. Anyone else? Any other questions? Or even if it's not related to these graphs, I think that's the last graph I've got for you. So, just to summarize, look, it's just the market carries on. It's still a strong market. The new listings are about the same as last year, and that is at low numbers. And if you're an owner, if you're a seller, then that's what you want. You don't want a lot of new listings to compete with you. If you're a buyer, then clearly it's not what you want. You are having to compete hard for a small number of listings, and naturally that means an even smaller number of good quality listings. Price growth appears to be continuing from the numbers in terms of the median sales prices and our experience on the front line just selling properties out there. It's our opinion that the prices being achieved for properties are still very, very strong. Duration to sell and sales volumes are both back to pre-COVID normals, about the same as we were 12 months ago, and overall stock levels continue to be low, and indeed lower by 15 to 20% than we saw 12 months ago. There is no market pain resulting from COVID yet, and I'm not suggesting that no one out there is experiencing pain of any kind, but the real estate market is demonstrating no real pain as a result of COVID. And I say yet because it's possible that it may be coming, but certainly no evidence of it yet. And it's my firm belief that long-term fundamentals remain strong, and indeed for that very reason, I'm in the market to buy myself as an investor. So I'm putting my money where my mouth is. The hardest thing at the moment is, well, two things I'm finding. Number one, finance is very, very difficult. Money's cheap, but it's hard to get. And secondly, there's just very little stock to choose from. So just like other buyers, I guess I'm struggling to find things that are that I'm interested in. So that's all I've got for you. Has anyone got any other questions? Speak now or forever hold your peace. Obviously, if you don't want to ask a question in this kind of semi-public forum, then I'm happy to just give me a call or send me an email or whatever. If you want any advice on real estate or wondering about your strategy or how much is your house worth or anything else, then obviously sing out, here to help.
Adam, Anne Collis here. I've got a question.
Hey,
Property, is there a price bracket in which properties seem to be moving faster? Because some indication is about anything over $1 million it's still sitting there, and I've seen them on Trade Me myself. So, for like pre-COVID, still there now. Have you got any thoughts on that? And also, can you make some comment on apartments? Because a lot are coming online, it's really interesting what's going to happen in that area. So your thoughts on that would be appreciated. Thanks.
Yeah, okay, very good. So in terms of popular price points, this will not be any surprise to anyone. People prefer cheap. So the more affordable it is, the larger the potential pool of buyers, and so certainly first home buyers are really still scrambling to get anything that's reasonable, tidy, and so on. And so for that reason, you see locations like the northern suburbs, which are a bit more affordable than, I don't know, the eastern suburbs or the southern suburbs or the central suburbs. Those locations are very popular and are seeing big traffic, at open homes, and also, for example, the Hutt Valley, Kapiti, maybe Porirua, these locations, it's a bit cheaper than the city, so the buyer activity there is still very strong. So, we're seeing first home buyers not uncommonly buying properties for $800, $900 million. I remember a couple of months ago, one of my colleagues sold a property in the eastern suburbs for about 1.2 million to a first-home buyer. Yes, the higher you go, the thinner is the oxygen, if you like, and so the fewer people can climb to those heights. But $1 million, 1.2, 1.3 is not a very expensive property in Wellington City anymore. I mean, if you're getting to 1.5, 2 million, 2.5, then yeah, the number of buyers is far patchier, and the buyers also become extremely fussy and are less motivated to transact quickly, because typically if you're buying a $2.5 million house or a $2 million house, you've currently got a $1.5 million house. You're comfortable. You don't have to move this month. Whereas if you're dealing with a first home buyer market, they are motivated by my finance approval is going to run out. My rental is coming. My tenancy room is coming to an end, or I'm just sick of prices going up and missing out on things. I am really motivated to buy and to buy quickly, and I have to punch hard because there are lots of people competing in this price range. And so that part of the market obviously moves quicker, but that's always been the case. It's no different after COVID. Perhaps at the very, very top end, you're seeing a bit more sticking on the market for a little bit longer.
Adam, it's Paul here. Just something I've been promoting and having a look at your figures there would emphasize what my thoughts are, and that is that I think it's an excellent time for people to trade up, or to, if they've got a property in an area which is not so easily rentable, etc., then it's a good time, I believe now, for them to sell that and then buy another property in a better location. It has better things going for it. I think that the market is fairly, I wouldn't say static, it's not the word I'm thinking of, but it's a good time, to actually look at trading up to properties. I'm not suggesting, well, they can if they want to buy more properties, that's fine, but the situation is if you can actually sell a place which is miles from anywhere, and even in the outer suburbs, etc., and buy something close to the city. Because the important thing, don't forget, is to remember that it's the tenants are our customers, and it's what they want which is most important. And often I find that what they want is a place that's close to amenities, close to the city, where they can get work part-time, etc., close to hospitals, where they might work at universities.
Yep. Close to services, close to bus routes, close to the city generally, with reasonable access and somewhere to sit outside and a bit of sun, you know.
Yes. So in trading up, you might have to spend an extra 100, 150,000 on a similar kind of building in a much better location. But I think,
well, I mean, I agree with you completely, Paul. A couple of things. Firstly, is that you will always get. I mean, most people who are buying properties are buying a home, right? So on that basis, you will always get twice. You know, typically you will get twice the home by increasing your budget by 50%. And so the higher you can go up, the better the value is, and so on. So I mean, I agree with that. And then the other thing that's really been interesting in the last few years, as the market has tightened and as prices have risen, properties that for a long time during the GFC, for example, were extremely difficult to sell because they had poor access or poor sun, or the layout was just not great, or they had compliance problems, or they just were not presented well, or access problems, these sorts of things. Now they are selling really well because the price is lower, and that's as far as buyers can go. So they are constrained by a budget. Someone might only have, I don't know, 800,000, and I say only, I mean, that's a lot of money, but, and that property, for example, 6 years or 7 years ago, you know, you could almost not sell for love or money because it had technical problems, or the access was terrible and it had no parking and that sort of thing. Now, because nothing else is available, you know, at $700,000 or $800,000, unless you go miles and miles out of the city, those properties are highly sought after. And you know, I've had several examples of properties like that in the last 12 months, where we've had just enormous numbers of open homes. Whereas 6 years ago, you would have been really desperately trying to attract 2 or 3 people to be interested and come and have a look. So I agree with you. Now is a good time if you've got some less desirable properties or less desirable locations and that sort of thing, especially if you can potentially sell to owner-occupiers as opposed to necessarily investors, because those owner-occupiers who don't have big budgets are really struggling to find anything that's affordable in half reasonable locations that are not miles and miles and miles away from the city. So yeah, that's a good point, Paul. I agree with you.
I think the other thing that maybe I should mention it, and that is that apartments in recent times have not been a particularly good investment because of a lot of buildings, apartment buildings around, particularly the big ones. They're needing to be reclad, they need to be earthquake strengthened, they need all kinds of things. And you can actually buy one of those and then suddenly find you up for hundreds of thousands of dollars actually in strengthening or so on. So my suggestion to people is that they do buy home and incomes in the suburbs in good locations as well there too, because anything up to 2 flats. So just briefly, we had a property in Willis Street, 3 flats, and it was deemed to be earthquake prone. So when I rang the council, they said, because I suggested, we turn it back into 2 flats. So as a 2-flat property, it wasn't a problem. It wasn't earthquake prone. But as a 3-flat, it was. So by turning it back into 2 flats, we were effectively getting more money in rent, and now it's not an earthquake problem.
That's right. So you avoided the problem with a very cheap solution.
Yes, that's right.
And you avoided 100,000 or 200,000 or whatever the case may be, a potential bill. But I disagree with you, Paul, in terms of the apartments. But what I would say is that, and this comes back to your point or your question about apartments. The apartment market is 2 markets really. There's the the more modern, purpose-built buildings that comply with the requirements. And those properties tend to be lower maintenance, they have lower body corporate fees, they have lower insurance premiums and so on, and are easier to manage. And the tenants love them too, because they tend to be warmer, drier, quieter buildings. And those properties have become extremely sought after by the first home buyers, because a first home buyer typically falls into 2 categories. one, they're a single person or a couple with no children, and in which case they want to live in the city. They don't need a lawn or a garden. They want to be close to all the amenities, and they want to be able to walk everywhere. They are after the lifestyle. If they are a first home buyer who have children or who are planning on children soon, then they are having to buy affordable properties with a garden or with some sort of outdoor space, and they are therefore having to go to locations which 5 or 6 years ago were not on the top of their list, so further away from town. And nothing wrong with these places, but places like I don't know, the northern suburbs, or Tawa, or further out in the Hutt Valley or Pororua, these places have become really, really way more desirable and have boomed. Not long ago, a house in Tawa easily you could buy for 400,000, and now the same property is 700, 800,000. Same for places like Paparangi, Newlands, and so on. Nothing wrong with these places, but when people had the ability to live closer to town, whether it be Karori or Kilburnie or anywhere else, they were preferring to do that rather than go further away. It's just natural. So as a result of those first home buyers being priced out of what they thought was going to be their first home, which was often something like a 2-bedroom cottage in Newtown or in Kilburnie or in Lower Bay or wherever the case may be, and then they instead of them being 500,000 like they were 5 or 6 years ago, they're now 800, 900,000. They cannot afford it, but what they can afford is a 1 or 2 bedroom 60 square metre apartment in a compliant building that's neat and tidy. When the roof needs to be replaced, the body corporate look after it for them. They don't have to get quotes. It's so easy, the lifestyle, as long as the body corporate is managed well, and the building is compliant, and so you don't have these risks of earthquake strengthening and recladding and so on. And those properties have boomed in price tremendously. The other market that you're talking about, which tends to be the character market, buildings which were often converted from office or warehouse space into apartments, they tend to have poorer performance on the earthquake resilience status, and significant maintenance issues, and so body corporate costs are high, insurance levies are high, and these places correspondingly sell really, really quite cheaply when you look at the per square metre rate. But it's all it's horses for courses. And for many years, I remember people asking me, everyone knows that apartment prices don't go up in value, and I just think, well, what a load of nonsense. How can everything else rise around you and apartments don't go up in value? People also would say, everyone knows that prices of properties in Wainui Mata don't go up in value. What a load of nonsense. Everything will hold its relative value in the marketplace. There are always these exceptions, like distortions will get created, as you've suggested, Paul, by things like the leaky home crisis, or this new requirement that the councils are bringing in for earthquake resilience status and that sort of thing. But these things aside, these anomalies aside, the general trend will be retained, generally. Anyone else? Questions, comments, thoughts? No? Time to go and grab dinner.
Yep.
And put your feet up.